Hello guys. So we solved few of the questions related to investment appraisal, and I ask you to try this one Yumna company question, which is related to sensitivity analysis. So we will be starting solving this, but before I start sensitivity analysis, let me give you a brief introduction of this topic. Sensitivity analysis is basically when you are checking how much change in a particular project variable we can afford. And let's say if you decide, if you are going to decide about a project, whether you are going to invest or not, and you are deciding it on the basis of net present value, and definitely you know that net present value is a result of different factors like sales volume, variable cost, fixed cost, your taxation, tax benefits. There are so many things which results in a positive or negative NPV. So based on these factors, when we calculate NPV and that NPV is positive, we accept a project. But in a situation where we are not certain, we are not sure of whether the values of sales volume, of selling price, or the variable cost or fixed cost or any other value, those values that we use in NPV calculation, we are not sure of whether the values will remain the same in the future as well, because whatever NPV we calculate on the basis of future cash flows. So if we are not certain of whether the values will remain the same that we have estimated, then we may want to check by how much we can afford a variation in a particular value. That thing is called sensitivity analysis. For example, let's say if we have estimated the price, the average price of the product, let's say to be $20, and throughout the 5 years project we have used this average selling price of $20 for calculating the NPV, and after calculating the NPV it's positive. So now based on the positive NPV, we will definitely consider it as an attractive investment. But at the same time, we are concerned about whether the price of 20 will remain 20, whether we will be getting this average 20 price throughout 5 years or not. So we want to check how much variation in this $20 we can afford. Let's say we reach to a conclusion that we can only afford a $5 per unit decline in this price. And if the price declines by $5, that is, it decreases from 20 to 15, the NPV will be 0. It means that if it further decreases, the NPV will turn negative, which we cannot afford. So the maximum change in this price that we can afford is $5, and if we convert it into percentage, it is 25%. 20 and 5 is 25% of $20. So we can say that we can afford a maximum change or a maximum fall of 25% in this price, and that is called sensitivity. But price, as you all know, is not the only factor. Variable cost is another factor, fixed cost will be another factor, and there will be other factors as well. So we will have different factors, and each factor's change will affect the NPV. And remember, a company can, the maximum change a company can afford is to have a zero NPV. What it can't afford is the negative NPV. So from a positive to zero NPV, it is still acceptable, but the negative NPV is not acceptable. So this is what sensitivity analysis is. And now let's check out this question. And we have to see how sensitive this project is to the project variables that we just discussed. So let's start. Humanart company is considering investing $50,000 in a new machine with an expected life of 5 years. The machine will have no scrap value at the end of 5 years. It is expected that 20,000 units will be sold each year at a selling price of $3 per unit. Variable production costs are expected to be $1.65 per unit, while incremental fixed costs, mainly the wages of maintenance engineer, are expected to be $10,000 per year. And the discount rate is 12%. And okay, so we have to check the sensitivity of the project. So let's, first of all, we have to calculate the NPV. So remember, first we have to see whether we are accepting this project or not. Maybe with the existing values, it is already negative. Then what's the point of checking the sensitivity? So first of all, we have to check whether the project has a positive NPV or not. So let's check it out. So I'll just write sales volume here, rates here, and the total here. So sales volume, it says that it will be 20,000. Okay, 20,000. Sales volume 20,000. Okay, the price is going to be $3 per unit. So the sales revenue for each year, first I'm calculating it on an annual basis. So every year we will be having a revenue of $60,000. And then we have variable cost. It will be for the same number of units, 20,000. It will be 1.65. 1.65 into 20,000. I am going to write it as a negative figure because I have to subtract. So the difference of the sales revenue and the variable cost is always called contribution. So the contribution per year is going to be 27,000 less the incremental fixed cost, which is 10,000 per year. And if we subtract this 10,000, the operating cash flows will be 17,000. Okay, so do we have any tax? We don't have the tax rate given. So let us ignore the tax for the time being. So that's it. That's the net cash flow that we are going to receive every year. So now let's calculate the net present value. For that, we need present values. And we need annuity factors because these are annual cash flows. So we will be needing annuity factor. So annuity factor, we will be needing an annuity factor for 5 years because the question says that the project life is of 5 years. That is it. So 5 years, we will be needing it for 5 years. So I'm just using a formula of annuity factor. Just if you want to note it down along me. It's one minus 1 plus the rate. The rate here is 12%. Here we go. That's 12%. 12%. Bracket close. Raised to the power minus 5 because we need it for 5 years. And then close this bracket divided by the rate again, 12%. So that's the formula for calculating annuity factor. So now annuity factor for 5 years at 12% will be 3.605, and this is something that we'll be using throughout this. Okay, so if we are going to have a sales revenue of 60,000 every year for 5 years, then what is going to be the present value of this figure? So I just multiplied with the annuity factor. Here we go. Similarly, if we have 33,000 of variable cost and that we are going to have for 5 years, so let's multiply it with 3.605, we will get the variable cost as well. So no need to multiply. Okay, let's multiply. We can multiply these two, or we can take the difference of these two. So let us take the difference of these two. It won't make any difference. And then we will have to multiply the fixed cost with the annuity factor, because this is also the annual figure. And now let's subtract. That's the present value of cash inflows. So 61281. From this, we have to subtract our investment to get the net present value figure. The investment is $50,000. So at the end, this is what our NPV is. So what do you people suggest? Should we go for this project or not? Just based on NPV. Should we go for this project or not? Yes. So apparently we are going for this project, but we are concerned about the changes in these variables. So let us check these variables one by one. First of all, it asks us to see the sales volume, but I will just check. I'll just go with sales price first. Selling price. I'm checking the sensitivity of this project with selling price. So sensitivity will be, remember, it should always be in percentage terms. So let me change the format to a percentage. Okay, now the formula of calculating sensitivity, let me write that formula as well, and I'll explain it later. The formula of sensitivity is equal to present value of after tax present value. After tax present value of project variable NPV divided by after tax present value of project variable. So what you have to do is, if in case there is a tax in the question, we don't have tax in this question, so that after tax is not relevant here. But in case we have a tax figure here, the NPV should always be after tax, and the value of the project variable should always be after tax. So NPV after tax should be NPV should be divided by the after tax present value of the project variable. Okay, so let us take the NPV figure. This is the NPV figure, and we should just divide it by the present value. Here is the present value, and since I'm checking with the price, therefore I should pick up the revenue. I have divided with the revenue, and now let us convert it into percentage, and it's 5.22%. So how I can explain this? The company can only afford a fall of 5% in price, because if it's more than 5.22%, it is definitely going to have a negative NPV. Let us check it out. Let us check it. Okay, remember this 5.22%. Okay, so I'm just reducing this $3 by 5.22%. So let me write it as is equal to into 1 minus 5.22%. This 5.22% has been rounded off, therefore it won't be exact zero. The NPV won't be exact zero, but it will be near to zero. So 3 into 1 minus 5.22%. So I'm reducing this 3 by 5.22% to see whether the NPV gets zero or not. Yes, it has approximately gone up to zero. This negative $9 is because this 5.22% was not The 5.22% was not the accurate figure. It was a rounded off figure. So here we go. We've just lost the positive NPV. And if the change is more than this, it will further go into negative figure, and we cannot afford, right? So a very relevant question coming up from Daniel, sir. If there was a tax, then how we could have incorporated it in this? What we would have done is, in the sensitivity formula, where we have picked up this 204996, we would have just multiplied it by 70%. This is what we would have been done. So we would have multiplied this P4 figure, that's 204996, by 70% in case there was a 30% tax. In this particular case, we do not have any tax, therefore we don't need to adjust. Janzib, even if the tax is in areas, in case of sensitivity analysis, the examiner does not give you abnormal things, because when you are trying to solve something, you assume things to be constant and in a normal pattern. So you can't plan or calculate sensitivity where you have abnormal patterns of cash flows. So whenever sensitivity will be given, rest assured that it won't be giving you abnormal cash flow patterns. Like you can easily ask me a question, sir, what if we have a different sales volume every year? Then we cannot calculate. If you already have different level of sales volume, how come we can set a benchmark? What if every year the selling price is different? Then how will we say 5.22% change? To what price we are talking about? So whenever sensitivity analysis is given, the question will be designed in accordance with the situation. Right, so let's go back to the 5.22%. Okay, let's check it out. Yes, Sunny, it should always be after tax if the tax figure is given. Okay, let's move forward to the second one, and I'll take your questions. Once I am done with all the sensitivity figures, then I'll take your questions one by one. Number two, it's the variable cost. So quickly, I want you people, you have figures right in front of you. You have the figures right in front of you. Just calculate the sensitivity with respect to variable cost. Use your calculators and calculate sensitivity with variable cost. I'm giving you 2 minutes. Okay, let's check it out. It's easy. Again, we have to pick this NPV figure and divide it with the present value of the total. Okay, and so it's minus 9.48%, which means that, okay, I'll just change the sign because we don't need minus here. 9.48%. Now what we can say is that the company can afford a maximum increase of 9.48% in its variable cost. Right, so variable cost. Okay, now let's check it out with sales volume. The third one, sales volume. Now this is a tricky one, right? So with when we talk about sales volume, you all know that if the sales volume increase or decrease, it affects revenue and variable cost at the same time. So we should always take the net of the sales and the variable cost figure. and the net figure is 97329. So 97329 should be taken as a project variable. So let's calculate the sensitivity. NPV divided by the contribution figure, and then change the format to percentage. So for fixed cost, we can only afford an increase of 11.59%. That's it. 11.59%. That's the maximum change or increase we can afford in our selling price. Similarly, the question hasn't asked us to calculate it with fixed cost, but let's calculate it for our practice. Fixed cost, sensitivity with the fixed cost will be calculated in the same way. NPV divided by the present value of your fixed cost, and let's change it. The percentage is minus 31%. Let's change the answer. So it's 31.30%. So the fixed cost has to go up by 31.3% before it makes the NPV negative. Now, last one is there can be a change to your cost of capital as well, right? This NPV has been calculated with an assumption that the cost of capital is going to be 12%, right? So what if the cost of capital changes? So how much change you can afford in the cost of capital? Now you all know the rate at which NPV gets zero. What is that rate called? IRR, right? So if your cost of capital goes up to your IRR, or it equals the IRR, your NPV will be zero, right? Everybody agrees to this point, right? If your cost of capital goes up to the level of IRR, the NPV will be zero. So you know what? It's a very simple to calculate the sensitivity of your cost of capital with the sensitivity of the project with the cost of capital. All you need to find out your IRR of the project first and see at what rate will the NPV be zero. So since in the last class we have already learned how to calculate the IRR, so I'm not going to calculate the IRR. This you can do it at your home. I'm just assuming a random IRR figure. Okay, just random. It is not the IRR of this project because I haven't calculated it. I'm just assuming a fictitious figure of IRR. Let's say that figure is 18%, and let's say we calculated this and we got 18%. So it means that if your cost of capital goes from 12 to 18, your NPV will be zero. So how much change is there? Tell me. 6? No, it's not 6%, right? Most of the students make this mistake. They say 6%. It's not 6%. It's 6 percentage points. You should say 6 percentage points. It's 6 percentage points, right? So what we have to do is we have to calculate that what this 6 percentage point is as a percentage of this existing rate, that is 12%. What we are saying, just ignore the percentage sign and just say the current cost of capital is 12, right? Forget about the percentage sign. 12. And if it goes up to 18, your NPV will be zero. The difference between the two is 6. And let's divide this 6 by 12. 6 by 12 to see how much this changes in terms of percentage. So it is 50%. The current cost of capital is 12. And if 50%, if it increases by 50%, that is 6, increases by 6, it will reach to 18 and NPV will be 0, and that is called the sensitivity. Mahim, you should we usually write sensitivity in percentage, not percentage points. So we should say 50%. That's what I'm writing here. Cost of capital. I have assumed that the IRR is 18%, right? So just for you people to refer it, I'm just writing it. Assume IRR to be 18%. Okay. Then what you have to do is you have to first put the change in numerator 18 minus the existing cost of capital, 18 minus 12, and divide by the existing cost of capital, and just change it the format to the percentage. It's 50%. So I hope everybody has got it. Okay, let me repeat it. I have assumed that at 18% the NPV of the project will be 0. I have assumed to save my time, but unfortunately I'm not able to save because I have to repeat so many times. So I've assumed that the IRR of the project is 18%, right? This is something that you will usually be calculating, and you have learned how to calculate the IRR. So I've assumed that at 18% the NPV will be 0. The current cost of capital as per question is 12%. It's 12%, right? So I'm just checking by how much this cost of capital has to increase in percentage terms so that the NPV is 0. So what I've done is I've just taken the difference of 18 and 12, ignoring the percentage sign. So the change is of 6 divided by 12, ignoring the percentage sign. It's 50%. I hope it's clear now. A quick yes from all of you will let me know that it's clear now. Yes, Daniel, that's also a correct way of doing it. Okay, let's move forward then. So now let's move towards our today's topic, day 3. So we have a question called Irvin Company. Let me make some space for me to do some working. So Arvind plans to raise $5 million in order to expand its existing chain of retail outlets. It can raise the finance by issuing 10% loan notes redeemable in 2015 or by a right issue of $4 per share. The current financial statement of Arvind are as follows. So it's basically a source of finance question, and we have to evaluate different sources of finance. As you know that the major sources of finance, there are two major sources of finance. One is the equity for a business, and the other is a liability or debt. And within the debt, there are so many other types of debts. So in this question, it has a choice of either issuing new shares at a right issue price of $4 per share, or issuing loan notes that will be redeemable in 2015 at, and the redeemable notes will have an interest rate of 10%. And its income statement for the last year, it's been given a statement of financial position at the at the end of the year. Ordinary shares, so all the stuff has been given. The expansion of business is expected to increase sales revenue by 12% in the first year. Variable cost of sales make up to 85% of the cost of sales. Administration cost will increase by 5% due to new staff appointments. Arvind has a policy of paying out 60% of profits after tax as dividends and has no overdraft. And what we are supposed to do is we have to evaluate. First of all, we have to evaluate. We have to check one option against the other and also comment on the effects of each financing proposal on the following. So we'll be using the same factors for evaluation, and then ultimately we'll be commenting that which of the options should be chosen. Okay, so but there was another requirement in this question. I'll do that as well, because once we do that, we will be able to comment and evaluate. And that was to prepare a forecast financial statements for the next year. For the next year, assuming both the options. That is, first we have to assume that the company is going for the loan notes, and then we have to assume that the company is going for the right issue. And in both cases, what the financial statement will look like in 1 year's time, that's what we are supposed to do. So let's prepare the forecast financial statements. Forecast FS. Okay, and let's move with both debt and equity. So debts and equity. So prepare 2 columns. Okay, let's start with sales. Okay, if the company goes for this expansion, its sales revenue is going to increase by 12%, right? So tell me, will it make any difference to the sales revenue that what financing option we choose? Will it make any difference to the choice? So it won't make any difference, right? The sales revenue will increase by 12%. You choose either source of finance. So 50,000 into 1.12, 56,000, and that is going to be, that will be the same for both years. Sorry, for both equity and debt finance. And these figures are in thousands. Okay, so we will just simply follow the format that they have already used. Then comes cost of sale. Cost of sale. Okay, for the cost of sale, we have to divide it into 2 parts, the variable part and the fixed part. Because if you just look at the question, it says that the variable cost of sale makes up 85% of cost of sale. So as you all know, if the sales volume increases, why should I multiply it by 1.16? The sales are increasing by 12%. So why should I be taking 1.16? I have multiplied it by 1.16. Okay, it's no, I have multiplied it by 12%. Okay, so as you all know that if the sales volume increases, it will increase the variable cost as well. It will increase the variable cost as well, but it will not change the fixed cost. That's why I have split the cost of sale into variable and fixed. So let's first convert the cost of sale into variable cost of sale, and that we can do it by taking the 30,000 figure given in the question. Just take 85% of that figure. Now this was for the last year. The 25,500 was for the last year. but this year it is supposed to increase as the sales are increasing. So we will simply multiply it by 1.12. So I hope it's clear for everyone. First, I have just taken the last year's variable cost and then multiplied it by 1.12 as the sales are increasing. So, and it should be the same for both years. Now let's take the fixed cost part, 30,000 into 15%. And it is not going to increase. So we'll just let it be 4,500 and 4,500. Right? So the total cost of goods sale, so cost of sale will now be okay, the cost of sales figure. Now, if I want, we can calculate the gross profit here by simply subtracting the cost of sale figure. Okay. So then comes the administration cost, which is 14,000. And if we don't have any other information in the question, we have to assume that it was all fixed. Okay, now here we go. It has stated that the administration cost will increase by 5%. So we will increase it by 5%. So the existing one is 14,000 and 1.05. We'll increase it by 5% and write it here. Okay, then comes profit PBIT. Let me write. So PBIT figure, we've got the PBIT figure as well. Okay, after PBIT we have interest. Okay, now here is where things will change. The interest cost in case of debt financing will now be different. Well, PBIT is a very common abbreviation, so you can use. Basically, we use abbreviations to identify what we are writing, so it should be clear. Okay, now let's come to the interest part. Okay, what is the existing interest rate? And then definitely if we are going with the debt finance, a further interest will be added. The existing interest is 300. Okay, so 300. And then we will be adding a further interest because we are in the debt column. So to 5 million has to be raised, and 10% loan, 10% will be the interest rate. So may I know what's the par, at what rate they are going to issue? Will they be issuing at par or what? Okay, so 10% of 5 million, 5,000. So it's going to be 800. That 12% is for the existing one, which is already there in the financial statement, right? The 12% is already in the financial statement, so we don't have to, we just picked up from the financial statement. And in this case, it should stay as 300 because if we are going for equity finance, then definitely there will be no increase. There will be no increase to your interest cost, so it will remain the same. 5,000 has been mentioned at the top of the question. Here it is 5 million. The debt, the new debt. Okay, so that's the interest. Now we will just use PBT, the profit before tax. Profit before tax. And then comes the tax figure. The tax is 30%. So that's your profit after tax. Then comes dividends. So how much dividends they pay? Let's go to the notes. Okay, Arvind has a policy of paying out 60% of profit after tax as dividend and has no overdraft. Okay, so 60% of this figure is going to be, so that's dividends, and then we have retained earnings. Yes, definitely. The profit has changed, therefore the dividend figure has changed. It's not dividend per share, which is mentioned in the question. It is dividend as a percentage of profit. The dividend figure here is changed because of the profits being different. The profit after tax in case of debt is 5208 and it is 5558 in case of the equity. That's why. So we are done with the forecast statement. Okay, there's a question from someone that why did we get 800? 800 is basically the existing interest and the interest on the new loan notes, 10% of the 5 million. Okay, let's move forward then. So now it has asked us to do some calculations and then comment on the effect. So financial gearing. First of all, let me reproduce the financial statement of financial position as well. So what do we need? We need ordinary shares. We need ordinary shares. In case of the debt, it will not change. It will still be 2500. The retained profits figure will definitely change. The existing retained earning profit and the retained profit during the year. So 20060 given in the question, the opening retained earnings, and then we will add the retained earnings during the year. So that's your retained earnings. 2500, no, this is going to change, right? This 2500 is going to change. Here the equity will be increased and okay. So how much is they are going to have? Remember, it is going to increase by the par value, right? The total value will be 5 million. So 2,500. So definitely the additional amount will usually go to share premium account or shares premium account, but here we don't need to classify it that way. So the 5,000 should be added here, 7,500, and the retained profits will be 20060 plus this. So that's your total equity now in both cases. So that's the equity figures. And what else we need is the long-term liability. That is the debt figure. Debts in the first case will be increased by 5 million. The existing one are 2,500. And the new ones will be 5,000, 7,500. And in this case, it will stay to be 2,500. So that's the debt figures. Okay, now let's come to the ratios. Financial gearing. Financial gearing will be, now there are two ways of calculating financial gearing. One is debt to equity ratio, and the other is debt to debt plus equity ratio, and it's up to us what we use. I usually use debt to debt plus equity, but it can be debt to equity as well. So financial gearing, debt divided by debt plus equity. .74% and 23.33%. It means that of your total capital, which is the sum of these two, 23.33% will be your debts in case you issue new debts. And if you go with your equity finance, your total gearing, that is total debts out of the total investment, will be only 7.74%. Okay, let me also show the existing status. For the existing, the gearing will be 2,500 divided by 2,500 plus 22560. Rhea is asking that should we mention in the exam which financial ratio are we using? Yes. When you are saying financial gearing, just right in front of the financial gearing in the bracket, mention that how you are calculating this financial gearing. Is it debt to equity or is it debt to debt plus equity? It's up to you. If the examiner has not asked a specific formula to use for financial gearing, it's totally up to you which one you use. They both give the same picture. Okay, after the financial gearing, there's operational gearing. Okay, for operational gearing, again, we have multiple formulas, but let me explain first. The financial gearing shows your financial risk. Just note it down. The financial risk shows your financial risk. That is your ability to pay your debts. How it's telling you that how much geared you are, how much debts do you have in your capital structure, and then you can assess yourself whether you are in a position to pay off the debts or not. So financial gearing shows the financial risk, whereas the operational gearing shows the operational risk or the business risk. Now, usually the businesses face the business risk because of the fixed cost. Because if you don't have enough sales volume, you will not have your variable costs as well, but you still have to pay for your fixed costs. So by the fall of your sales volume, the only problem that you will get is the recovery of your fixed costs. So operational gearing shows your business risk. Now, the formula for operational gearing, let me write this formula somewhere so that you people know. Operational gearing is equal to contribution divided by PBIT. You know that the difference between contribution or profit before interest and tax is the fixed cost. So if you have a higher contribution, but at the end you are left with a very low level of profit before interest and tax, this means that you have deducted a big amount of fixed cost from your profits. So a higher operational gearing means a higher business risk. It indicates a higher level of fixed cost. So let's calculate. What was the contribution? We don't know. We have to calculate the contribution, right? So that's why I separated the variable cost figure from. So what we have to do is from the sales figure, we have to subtract the variable cost to get the contribution figure and then divide it by the PBIT figure. So that's your operational gearing, and it is always written in times. 3.33. And let's do it. Just copy paste this here. No change. No change to your operational gearing, whether you are going for a debt as a source or you're going for equity as a source. There is no change to your operational gearing. And just a one sentence, tell me why is that so? Why is there any change in your operational gearing because of equity or debt choice? Wahab, we haven't ignored the share premium. We have included a share premium, but we haven't shown it separately. We did not need to show it separately. No, unfortunately, no answer is correct. Because operational gearing, as I told you, operational gearing shows your business risk, not the financial risk. And choosing debt or equity, it's a financing decision. It's a financing decision and should always be reflected. This change should always be reflected in your financial gearing, not the operational gearing. Remember this, note it down somewhere. Operational gearing shows business risk, not the finance risk. It does not show financial risk. That's why whatever source of finance you choose, it will not affect your operational gearing. So it will remain the same. And then let's calculate the existing operational gearing. Existing operational gearing. The existing operational gearing will be calculated with the given figures. So the sales figure 50,000. Okay. So let me write 50,000. From the 50,000, we have to subtract the existing variable cost, which was 85% of the cost of sale. The cost of sale figure is 30,000. 30,000. And we should take 85% of this figure. So variable costs have been subtracted. Now divided by the PBIT figure given in the question. The PBIT figure in the question is profit before interest and tax is $6,000. It's 0.08 times. So the operational gearing before the investment was higher, 4.08, which means after you expend, irrespective of which source you choose, but if you expend, your operational gearing is going to go down. So your business risk is going to reduce with this investment, not because of the source of finance, but because of the investment, because of the expansion decision, 4.08. Then comes the interest coverage. Interest coverage is how many times profit do you have to cover your fixed, so to cover your interest cost. Let's go to the top and see what PBIT did we have. It's 8240. So we had 8240 profits available to pay off a debt, interest. How much interest we were supposed to pay in case of the debt option? What's the amount of interest that we need to pay in case of debt? 800, right? And against the 800 of interest, we have $8240 of profit. So how many times it is? Let's divide it by 800. It's approximately 10 times, 10.3 times. Similarly, let's copy this formula and paste it here. 27.47 times in case of equity finance. And the existing one, PBIT is 6,000 and the interest is 300. 6,000 divided by 300, 20 times. And last is the earning per share, EPS. The earning per share. So for earning per share, we always take PAT, profit after tax, and we'll have to divide it with the number of shares. Okay. So PAT was 5208 divided by the number of ordinary shares. Now, in case of debt finance, the number of ordinary shares will remain the same as given in the question. So that we can calculate by dividing the share capital figure by 25 cents, in that is $0.25, to get the total number of shares. So can anybody do it for me? From this information, as you people have passed your F7 paper, somebody told me that we have passed F7 paper. So tell me, what should be the total number of ordinary shares? Everyone. Good. So how we do it? 2500 divided by 0.25 cents. It's 0.521 per share, right? EPS. Okay. But when we come to this debt finance, sorry, equity finance, the number of shares are going to increase. So just divide 5 million by 4. We will get the additional number of shares that we are going to get. 5 million, and each share is going to be issued at $4. So profit after tax divided by 10,000. I'm just writing it straight away. 10,000, that existing number of shares, plus 1250, the new shares. And the earning per share will be 0.494. And what about the existing EPS? The existing EPS will be the profit after tax. Profit after tax is 3990 divided by 10,000. Okay, so here is the situation. Now comes the evaluation. We're done with the calculation part. Now that comes with the evaluation. Now, we have two choices, either to go for debt finance and equity finance, right? But we have to base our commentary or evaluation on these factors. First of all, let's start with a slight introductory paragraph. So I'm just now, whatever I am saying now is just a solution that is I'm proposing for this type of question. Okay, so just listen carefully as if I'm writing in the exams. When choosing a source of finance, a company has to look at it from the investor's perspective as well as from the company's perspective. It has to look at its financial gearing. Because of the financial gearing, or financial gearing is one of the factors or one of the indicators of financial risk. Therefore, a company has to look at its financial gearing to see if its financial gearing is at a dangerous level or not, or whether it can afford to increase its financial gearing. So if a company has already a higher level of financial gearing, then it cannot afford to go for debt finance further. So it must have to look at the equity finance. In this company's case, we don't have industry figures given. We can say that the debt finance will increase the financial gearing from 9.98% to 23.33%. But whether the 23.33% is acceptable or not, we have to look at the industry averages. Definitely, this is our limitation, right? We don't know whether the 23.33% is a high gearing or low gearing because we don't have industry statistics. So this is what we have to mention in the question, okay? Secondly, there is operational gearing as well, but operational gearing shows the business risk of a company. Therefore, it's not considered as one of the factors when deciding up between the source of finance. That's why the operational gearing figures are same for both cases. Interest coverage is another indicator that must be considered when choosing between the two sources of finance. It is also one of the ratios that are being used by the lenders, by the investors. The current interest coverage ratio is 20 times, which is quite significant, which is quite good. If the company chooses to go for debt finance, its interest coverage will be reduced to 10.3 times. It still looks good. The 10.3 still looks good, but again, we would have been in a better position to tell whether the 10.3 is good or not in case we had statistics of industry. Last, the earning per share. If the company chooses equity finance, its earning per share will increase from $0.399 to $0.494. But if it chooses to go for debt finance, it can increase it up to 0.521, which is a very good. In the absence of any other information, the debt finance seems to be an attractive source of finance for this company, as it is apparently not increasing the financial gearing to a dangerous level. It's not changing your operational gearing. It's not decreasing your interest coverage to a dangerous level, but it is increasing your earning per share, which is a very good indicator. Therefore, debt seems to be an attractive source of finance here. That's how we should be discussing and suggesting which source of finance should be chosen. Last part, let me explain the last part and then I'll take your questions. Discuss the dangers. Discuss the dangers to a company of a high level gearing, including in your answer and explanation of the following terms: business risk and financial risk. So let me explain the business risk and financial risk first. What is business risk and what is financial risk? Business risk. Okay, I'm not writing a standard definition here, okay? So it's a very generic definition. Business risk. It's a risk that a company may fail to cover its operating costs, particularly fixed costs. Financial risk. It's a risk that a company may fail to pay its debts on time. Right? So if a company has a higher level of operating gearing, in this company's case, it's 3.33. We don't know whether it's a high level or low level. We have to look at this industry statistics to see whether it's a high level gearing or not. But in case if it's a high level, it has a high level of operational gearing, it means it has a high level of business risk. It means that if the sales volume are volatile and if the sales volume are not constant, the company will have a high risk of making business and or operating losses. So for a company that has volatile sales volume, it cannot afford to have high level of fixed cost. Its business risk will be so high. On the other side, if the financial gearing is on the higher side, it will have two types of risks. Number one, the risk of image, because the investors will also see the company, the new investors will also see the company to be highly riskier as they will, if they see a high gearing level. So they will be reluctant to invest in the company. Secondly, the business will also have to face a risk that it may not pay off its debts on time when they fall due. Right? And let me give you an example. In this COVID-19 situation, where most of the governments they imposed lockdown strategy, and the business were operating from home, and they lost a huge level of sales volume. Those businesses that had a high level of fixed cost had severe problems in running their businesses. Like airlines, most of the costs of airlines are fixed. They have ground staff, they have air staff, they have the maintenance cost of the airplanes. They have to pay for the they have to pay rent to the aviations. So a lot of fixed costs they had. So that industry was highly affected. Now I'll be just taking your questions, 5 minutes, then we'll be taking a break. So I'm giving you 5 minutes to ask questions. After that, I will give you a 10 minutes break. No, this question does ask us to evaluate the options. So usually when you evaluate, you have to reach to a conclusion that which source is good. Interest coverage. Okay. Let's say if you have $40,000 of profit before interest and tax, and you have $10,000 of interest to pay. So interest coverage will be 40,000 divided by 10,000, that is 4, which means 4 times. Or in other words, you can say that to pay off $1 of interest, you have $4 of profit. To pay off $1 of interest, you have $4 of profit to pay your interest. That's called interest coverage. Taha is asking whether it was necessary to prepare the financial statements. Without these financial statements, how could we have calculated the financial gearing, the operational gearing, the earning per share? All these figures have been taken from those prepared financial statements, so it was mandatory. So if we have a better interest coverage and a better financial gearing, but worse EPS, why would we be why would we why would we go for the debt? Can't we just be more secure and earn 3 cents less? Well, it's a subjective matter, Vasil. It's a very subjective matter. It depends on the management style. It depends on your investors. What do they prefer? You cannot have a straightforward answer to these type of questions, but you can also give your suggestion based on relevant arguments. Sunny, can you just explain your question? Well, there's a question that which interest coverage ratio is favorable for a company, a high one or a low one? Well, again, it depends. Uh, Usually, now I'm talking about, though I'm not a big advocate of going for a debt finance. So I always discourage debt financing due to certain reasons. But uh, from a financial management perspective, um, businesses want to go for debt finance because debt is a cheaper source of finance. Therefore, their tendency will usually be to acquire more and more debts than issuing shares due to several reasons. You will never want people to become your partners, right? So if you issue shares when you need money, you're just making somebody partner throughout the life. So that's why people prefer to issue debts or issue loan notes so that they don't make somebody partner for the life. Secondly, it's a cheaper source of finance to have debts. Therefore, the inclination will always be towards the debt finance. Now, your question whether higher is in a good or bad, the lower is good. Neither of the two in this case will be good, because a higher interest coverage ratio would mean that you have the potential to acquire more loan because you have profits to pay off your interest. So it indicates that you are relying less on your debt financing, which is not good from financial management perspective. A lower interest coverage ratio would mean that you have a high risk to pay off your interest. You don't have enough profits to pay off your debt, your interest. So neither the higher or nor the lower interest coverage ratio is good for any business from a financial management perspective. Well, how come you can say the gearing is higher? We don't have industry statistics, so we cannot say with surety that 23.33% gearing is higher. We don't have industry statistics. But if you ask my personal judgment, 23.33% is not a high interest coverage ratio, because it means that you still have 77% of equity finance and you have 23% of debt finance, which isn't a big gearing ratio from my personal judgment. But industry statistics are more important in this case. Robert, I did not say EPS is the best judge. Yes, EPS could be one of the important factors here, as other ratios, they don't seem to be very dangerous. That's why EPS is helping us to decide. Yes, Asad, I've taken it from the question. No, part, the capital structure theory is something else. The capital structure theory has a connection with the valuation of the company. So whenever they connect the capital structure with the value of the company, and then they ask you to discuss something, then we use capital structure theories. No, EPS will still be a better choice, but I feel even going for debt finance, these ratios are still good one. They look good in the absence of any other information. And EPS is better than these two. Though these ratios have decreased now, but not decreased to a level that is creating a worry for us. Mahim says that if I had suggested equity finance, would I have still got marks? Well, you need to be logical. The beauty of the financial management paper is you can suggest anything that you want, but you should be logical. You should have a logic behind whatever you are suggesting. No, Rubed, usually we don't have any we don't have benchmark rates or rule of thumb for all of the ratios. We have for few, like we have for current ratio, that is 2 times. Quick ratio should be 1 time. The interest coverage ratio is usually considered 3 times of interest coverage ratio is usually considered to be a good one. 4 times will be even better. But for all other ratios, we rely too much on the industry. So there is no wrong answer as long as it justified the explanation. Definitely. You know what is the aim of ACCA? ACCA wants you to become more practical in your lives. And in your lives, if somebody asks you which cell phone should I buy, which cell phone should I buy? Do you really think there is one best answer to this question? No. It depends on, if you are recommending a particular cell phone, what are the factors that you have put forward? It's all about convincing someone to your point of view. So there are 2 types of things in life. One is a subjective thing. The other is the objective thing. If someone asks, what's the time at the moment? It's not a subjective thing. So you have to be accurate in that. But if somebody asks, how's life going? That's a very subjective thing. You may say it's going good. Somebody else will say, no, it's not going good. I feel you are in a miserable condition. So it's a subjective thing, right? So in subjective type questions, you can have your opinions justified by the logics, by the facts and figures. Okay, let's take a 10 minutes break. We'll be back after 10 minutes. And also, if you can just tell me how is the session so far today? From 1 to 5. 1 being poor, 5 being excellent. From 1 to 5, just tell me how is the session going so far? I'm literally honored to see all of your comments. Thank you so much. Yes, I do pray that all of you who are attending this session should pass your exams. I do pray for all of you. Inshallah. Yeah. What question do you want me to answer? Excuse me. Yeah, I do give classes for AFM as well. Financial management is one of my favorite subjects of the whole ACCA. Well, for the face-to-face classes, I teach in Karachi, but I also offer online classes. Sir, I can't evaluate the ratios. How can I explain, for example, interest coverage? Well, interest coverage basically tells the ability of a company to pay off its interest. For example, if it has a 5 times interest coverage ratio, that means it has $5 of profit available to pay off $1 of interest. So let's say if you have $5 in your pocket, right? And out of the $5, you have to pay just $1 for interest. So you're in a good position. Your friend who has just $2 in his pocket and he has to pay $1. So who is in a better position? Yes, Zainab, I shared my contact number or the WhatsApp number. So I hope you are in the group, in the WhatsApp group of FM that I created. Mudassir, did you get the answer? Zainab, are you in the WhatsApp group? Okay, I'll be sharing the details there. Okay, Parvati, that's great to know. So how has this session been so far, Parvati? Because you have already studied F9, so you'll be in a better position. Yes, my number is +92321260403. That's my number on your screens. Great to know this, Pravati, that you're finding it effective. So I hope all of you are taking your exams in September. Yes? Yes, Pravati, you can ask me on WhatsApp about AFM. Well, I think, Kutsia, apart from the technical requirements, if you are done with your technical requirements, I think it's far too relaxing to take your exam at home than taking it in the exam environment. I am a big advocate of taking exam from home. If I had this choice of taking exam from home, I would have never chosen anything else. That's my choice because you'll be sitting chilled at your home, taking your exam. You don't have to travel. You don't have to waste your time traveling. So there are so many benefits of taking exam from home. But having said this, there are inherent problems with different students. So some maybe people they don't have laptops or the internet. So that's another thing. Yes, that's something that I wanted to discuss with all of you. That um, um, what you can do is to solve the MCQs without a scratch pad. I would suggest that once you start your exam, right, go to your CRQ, constructed response questions place, and see which question has a spreadsheet. Okay, so mark that question and come back to your MCQs. Okay, copy the MCQ data, go to that spreadsheet, solve it on the spreadsheet, take the answer, and click on the MCQ, the right answer. So you don't have to use the scratchpad for MCQs even, and it will be too easy to use it to use spreadsheet to solve MCQs even. Sheros, did you get it? Okay, even if the exam software does not allow you, you can still remember the question, right? You can just put the key figures in the scratch pad and come to the spreadsheet part, solve it. I don't think it will be difficult. When you talk about MCQs, most of the MCQs are solved on calculators. And as far as the CRQ questions are concerned, for that you will always have spreadsheets, so you don't have to worry about it. I think don't listen to the students. So man, when we listen to people who don't have the experience, they just have a fear factor that they transfer to you. Okay, Pavati, are you from India? Okay, I've heard there's a strict lockdown there. Okay, so let's start our session. We are done with the break. I hope you have enjoyed the break, but you did not let me enjoy my break. But anyhow, let's move forward. Yes, Sunny, you're right. That's what I meant. Okay, now let's move towards our next question. And that is using the capital asset pricing model, calculate the required return of on equity of CAP company at 30th September. Ignore any impact from the new campsite project. Briefly explain the implication of a beta of less than 1, such as that for CAP company. Okay. Let's calculate the cost of equity using CAPM model. Now let me first explain a quick explanation of the CAPM model. It's a very natural model, a very simple model. It says the higher the risk, the higher the return. So if you have a higher risk, the people will expect a higher return, right? But that does not mean if there is no risk, people will not expect any return, right? So it says that even if there is no risk, and if you ask for money from someone for a business purpose, that someone will expect you to give him at least some return, even if there is no risk. And that return is called risk-free return. Usually the government securities, the return that people get from government stocks is considered to be risk-free, theoretically speaking. Practically, there is no investment in the world that is risk-free. So there will always be a risk-free return according to CAPM model, right? So let me assume it's 5% in a given situation. Okay, it means that people will ask for 5% minimum return. Okay, then there will always be a premium against a risk. If you want me to invest in your company, which is more riskier than a government security or government investment, then definitely don't expect me to be expecting the same return that I expect from that government security. So I'll be expecting a higher return to compensate for that risk that I'm taking, and that is called risk premium. So there are two types of risk premium: a risk premium that we expect from a certain or specific company, and a risk premium that we expect from a market in general, the average risk premium that we call. So let's say from a particular market, I'm not talking about a particular company in that market, I am talking about the market as a whole. We expect a return of, let's say, 14%. So, right? In a risk-free investment, we are good to receive 5%, but from a market that has a risk, we expect 14%. So how much additional amount we are expecting, how much additional we are expecting against the risk. What's the additional that we are expecting from this market? 9%, right? RM minus RF, difference of the two, 9%. This is called risk premium, but this is market risk premium. This is something that we expect from the market as a whole, not from a particular company. Okay, that's from the market. Okay, now my question to all of you, do you think every company in the market will have the same risk level? No. So do you expect the same premium from a specific company that you expect from a market as a whole? Never. This 9% additional premium is just that you expect from the market as a whole, right? Okay. Okay. 5% is something that you will expect from every company. The additional 9% is that you expect from the market as a whole. Okay. Now let me tell you one thing. If you have a company A in the same market, right? You have a company A in the same market, and I tell you that this company A is twice as riskier as the average market, right? If you compare it with the market as a whole, this company is twice as riskier as the market. And when we say twice as riskier, what we mean? We mean that if the share price of the market, the average share price of the market goes up by, let's say, 20%, the share price of this company goes up by 40%. Similarly, if the share price in the whole market goes down by 20%, the share price of this company goes down by 40%. So it is twice as risky or volatile as the average market. This is the risk level. Okay. How much risk premium will you expect from this company now? If you expect 9% additional premium from the market as a whole, and this company is twice as riskier as the market, how much premium do you expect from this? 9% into 2, right? 18%. But this 18% is the premium, risk premium, not the total return. What should be the total return that you expect from this company? That is just the additional amount that you will be expecting from the company, not the total. So 18 is the risk premium, and in this risk premium we have to add the risk-free return, 5%, 23%. This is what you will be expecting from this company, and this is, by the way, your cost of equity of this company. If you expect 23% as an investor from this company, it means the company has to pay you this 23% if they want to get investment from you. So from your perspective as an investor, it's a return. But from a company's perspective, it is a cost. The cost of equity, 23%. Now, this is what the CAPM model is. This 2 times is basically the equity beta of the company. That is a statistical value of showing a risk. The 2 times mean the company is twice as riskier as the average market. So the formula for the CAPM model to calculate the KE is risk-free, 5%. That is something that you will always ask for, plus the difference between market return and the risk-free return. That is the risk premium, market risk premium, multiplied by the equity beta, the 2 times 1. So that's the formula for calculating cost of equity under the CAPM model? So a quick yes, so that I know you people have got it. Okay, great. So let me remove all these and let's go to the question and see how we can solve this for this question. So should I give you 5 minutes to solve this question and then I solve it for you? Or should I start straight away? Because we only have one more question to solve today and we will be done with today's session. So should I give you people 5 minutes to solve this question? Better you people solve it first and then I'll come back, right? So this question is there in your handouts as well, but you can look at the screen as well. Okay, so let's solve it now. It's a relatively easier one. We have 5% as our risk-free return. The market expects 15%, okay, minus 5% into 0.8. So it's 13%. The cost of equity is 13%. Okay, so you people were right. Okay, we are done with part A. It's okay. No, we are not done with the part A. Now it asks us briefly explain the implication of a beta of less than 1, such as that for cap company. Now let me now explain it. We have risks, right, in a business. Quickly explaining the risks. Risks. There are two types of risks that a company will face: systematic risk and unsystematic risk. Right? Now I want you people to listen carefully. Systematic risk and unsystematic risk. Okay. Now let me ask you a few questions. Systematic risk is a risk is also called a market risk, that a risk faced by the whole market. It's a market risk. Whereas unsystematic risk is called a company specific risk, the risk faced by a particular company only. Right? So I'm asking you a question, just answer me. Let's say there's an airline, right? And this airline has purchased small jets, let's say 6 or 8 seater jets, so that it can allow customers to book chartered flights, right? This decision of the company may prove profitable or it may prove otherwise, right? So what do you think? Is there a risk in this decision or not? There's a risk, right? But what do you think? What type of risk is this? Is it a systematic risk or unsystematic risk? It's unsystematic risk, right? It's unsystematic risk. Okay. It's unsystematic risk because this is just a risk faced by this individual airline, right? Okay. Let's say there are 2 airlines in the market and there is no other airline in the market. There are only 2 airlines in the market, airline A, airline B, right? This airline A has taken this decision. The airline B hasn't taken such decision. Okay. If a customer does not like a decision of airline A and wants to switch, where will it go to? Airline B, right? So the sales or profitability will shift from airline A to airline B because of the poor decision, or it may be vice versa. Okay. You are the investor, right? You are the investor and you think that you should be investing in airline A, but you you can see that risk, but you can also see that return. So you want that return, but you also want to manage the risk. How can you manage the risk? How can you reduce your risk? You have a choice of investing in either of the two or both of the two. So what will you do to reduce your risk? You will invest in both, right? And that is called diversification. And that is called diversification of risk, right? So what you will do, you will invest some part of your capital in airline A and some part of your capital in airline B. In case airline A's decision fails, you can get that profit from airline B. And if it clicks, you'll get that profit from airline A. So tell me, from your own decision making, from your own portfolio of investment decision, you managed a risk. Which risk did you manage at your own? The systematic or the unsystematic? Which risk we were talking about? We were talking about the unsystematic risk. So by managing your portfolio in a way, you can reduce your unsystematic risk. That's why we usually do not ask for a higher return. We don't ask for a market risk premium from against unsystematic risk, because we can, though it will be our desire to get as much profit or as much return as possible, but even if we are not getting, we will still invest, because we know that we can reduce this risk by our own decisions. So remember one thing, against unsystematic risk, people don't ask for premiums. They manage it at their own. Now let's come to the other one, COVID-19. COVID-19, the lockdown. Tell me, is this risk going to be faced by a single airline or the whole market? That risk is called systematic or market risk. So whether you invest in A or you invest in B, you will have to face this risk. So you cannot diversify this risk. Therefore, whenever you will decide to invest in an airline industry, whenever you will be deciding to invest in airline industry, you know that you cannot diversify the systematic risk. Therefore, you will always ask for a premium. And that equity beta was against systematic risk. Remember this thing. This is always against the systematic risk. The equity beta reflects systematic risk, the market risk. Because you know, even if you invest in a particular company or you invest in any other company, you will face this risk. Therefore, you ask for a higher return. So remember, equity beta represents systematic risk. Systematic risk. Now, in this systematic risk, again, there are two types of risks. What are you saying, Janzev? Salman? Wait, I'll don't jump to the next part. Well, I've just given you example of COVID-19. It's an abnormal situation. I just gave you an example that if there's a risk of anything happening that affects every company in the market, and you are in a time of making investment in that market, you will always ask for a premium. So anything that you think may happen, which affects the whole market, in that case, you will always ask for a risk premium. Okay. Now in the systematic risk, there are two types of risks. There are two types of risks: business risk and financial risk, which I discussed earlier as well. The business risk is faced by every business in this market, whereas the financial risk is only faced by a business which is faced by a geared company, a company which has debts. And business risk is faced by every company in the market. The business risk is statistically shown through asset beta, whereas the financial risk is shown through debt beta. And the debt beta is usually so low. It's usually so low because usually the investors, when they are giving you loan, they will keep a property as a mortgage and they will secure it. So we can assume the debt beta to be zero in most of the cases. So it will only be the asset beta in most cases, right? So remember one thing now. Equity beta shows both business and financial risk. Remember, it always shows both financial and business risk. A company which has no debts will only have the asset beta, that is only have the business risk, and its asset beta will be equal to its equity beta, as there will be no financial risk. So we can say that if a company is 100% equity finance, or we call it ungeared company, 100% equity finance company will have equity beta equal to asset beta, whereas a geared company, note this down, okay, geared company will have equity beta as weighted average of asset and debt betas. Right? So this is a brief introduction of systematic, unsystematic risk, asset beta and equity beta. So I'll be jumping to the question. It asked us to explain the implication of a beta less than 0.8. Now you will be getting an idea. If you have a less than, let's discuss different types of values of equity betas. Equity beta, if it's equal to 1, what does this mean? This means that the company is as riskier as the average market. So whatever risk premium people expect from the market as a whole, they will expect the same risk premium from the company because it has equal risk level as market. I'm not talking about its competitor, I'm talking about the whole market. So it's as riskier as the average market is if it has an equity beta of 1, right? Equity beta of more than 1 means it's more riskier than the average market. So 1 means if the, let's say, if the earnings of market go up by, let's say, 10%, the company's earning will also go up by 10%. It will increase or decrease in line with the market. But if its equity beta is greater than 1, it means the earnings of company will change more than the change in market earnings. Similarly, if it has less beta, that it means its earning will change, increase or decrease less than the change in the market. So this is what they have asked us to explain. Is it clear? Yes or no? Okay. So Let's move forward to the next part of the question. In the next part, it says calculate weighted average cost of capital of cap company. Use your calculation in answers to requirement A and above for the cost of equity. Ignore any impact of. So ignore any impact from the business. So you have to calculate the WAC, weighted average cost of capital. Let's calculate the weighted average cost of capital. Let's calculate weighted average cost of capital. We already have cost of equity, so let me write the cost of equity figure here. 13%. Okay. Now let's go to cost of debt. Let's calculate cost of debt. So first of all, we have to see what type of debts do we have in our capital structure. 9% irredeemable preference shares, 8% loan notes. We have two types of debts in our capital structure. The one is 8% irredeemable preference shares. So let's first calculate the cost of debt of this. Basically, the cost of debt is what we are paying to our investors. That's the cost of debt. So we are paying 9% for a preference share which has a par value of $1, and the interest is always applied to par value, remember. So 9% of $1 means $0.09, or we can say 9 cents, right, per share. So we are paying 9 cents per share of interest on this. But we have to always compare it with the market price, not the par value, because the investors will always look at their investment value rather than what you have recorded in your books. So cost of debt will always be calculated by dividing it by the market price. So I'm just doing it here. Cost of debt of preference shares. So it's let's first see what's the price of the share. Ordinary share price were quoted at $3. We don't need ordinary shares, we need preference shares. The market price per preference share was $0.9 ex div. Okay, it was $0.9, and 0.09 is the interest against 0.9. Okay, now it's preference shares, or against preference shares we pay dividend, right? And dividend is never ever a tax allowable expenditure, so we should never take it as after tax. But in case it was a loan note, or in case it was something for which we were paying interest, then we should always make it after tax. The numerator should always be made after tax. Here we don't need to. So simply divide it with the market price, and it's 10%. So the cost is 10%. So in short, the company is paying 9 cents against a 90 cents value of share. So it is paying 10% to its investors. That's its cost of debt. Then comes the 8% loan notes. Okay, and it is redeemable in 2003. Okay, and it's September 2002 now. Loan notes interest is paid annually in arrear and is allowable for tax at a rate of 30%. The loan notes were priced at 1057x interest per 100 nominal on September 2002. Loan notes are redeemable on 30th September 2003. From financial management perspective, we consider it part of debt. Remember, we always consider it as part of debts because we have to pay a fixed amount every year. So redeemable loan notes. Now remember one thing, for redeemable loan notes, we always calculate IRR, the rate of return. So let's calculate IRR for this. And it's a 1 year. So I'm showing working here. Loan notes, okay. Year 0 and particulars. This format will be very useful for you. Market value, cash flow. So we should always take market value as our 0 point cash flow, and it is 100.57. That's cash flow. Okay. Discount factor slash annuity factor if and present value. Now for IRR, we need to assume two rates. And my suggestion to all of you is always assume one rate lower than the interest rate, that is 8%. Lower than is 8%, and one rate should be higher than this 8%. So let us take 5% as the first rate. 5% as the first rate, and then we will take a higher rate, let's say 10% as a second rate to calculate the IRR. Okay, from since it's 2002, September 2002, and we are going to redeem it in after 1 year. So we only have 1 year. Otherwise, we would have written it as 1 to 2 or 1 to 3 or 1 to 4 years. So interest will be paid, and it should always be after tax. So what's the amount of interest? 8%, and the par value is always $100. So 8% of 100 will be $8, and we should make it after tax if there is a tax rate given in the question. Do we have a tax rate in the question? Just check it out if there is any tax rate. Yes, 30% tax rate. 5.6. So the interest paid will be 5.6. Usually we ignore the arrear thing since it was for only 1 year. It was only for 1 year. So we can consider, or we can just ignore that arrear thing. That's up to us, because usually we ignore that arrear thing when it is for 5 years or 6 years, right? So for the time being, for simplicity's sake, we will be just ignoring that arrear thing. So we assume that we will be paying this interest for in year 1. Now the discount factor will be 1. and discount factor for 5% will be 1 plus 5% raised to the power minus 1. So 5.33. So the total present value will be 95.237. That's your NPV. Okay, there will also be redemption. So we have to take redemption as well. After 1 year, the amount will be redeemed. And the redemption value should always be taken as positive. And if nothing is mentioned, we usually redeem it at par value. So $100. And the same factor should be used in this case. And now let's net it off. It's too low. So we can say that 5% is approximately the IRR, the cost of debt. Athar says that, sir, why are we not taking interest as a negative value? Because we are looking at it from a investor's perspective. Though it's our cost, but it is a return for the investor. So we are just calculating from an investor's perspective, and the investor is going to get the interest and these two values, and it has to pay us this $100. So from an investor perspective, $100 is its investment, then these two will be received by him. So that's why we have taken it as positive values. Okay, so it's almost equal to 0, but it's still positive. So let's take a slightly above rate, but it's around 5%. The cost of debt is around 5%, but let's take another one. Take a discount factor higher than this. Though I don't need to do it anymore because I've already got a 0 NPV, almost 0 NPV is there at 5%. So I can take 5% as my cost of debt, approximately 5%. But just for you people, to how we can calculate it otherwise, I'm just taking another rate as well, and I'm taking it as 8%, let's say. And let me copy this one as well. I'll just have to change the rate. Instead of 5%, I'll just take 8%. 0.926. The same should be used here. And we will calculate the PVs again. 1 into the market value, 0.926 into the value of interest to get the present value of interest, and 0.926 to get the value of the redemption value. And let's sum them. So we have got a negative minus 0.27. Now let's calculate the IRR. For IRR, we need a lower rate, which is 5%, plus the positive NPV, which is, this is the positive NPV divided by the positive and the negative into higher rate minus lower rate. So it will be approximately 5%. Like you can see, we just got it 5% because it was almost equal to 0. So just for you people, I calculated it in a proper way. Otherwise, I could have just used this 5% as my cost of debt. So that's a cost of debt of preference shares. Now comes the weighted average cost of capital. We have got cost of equity, we have got cost of debt of preference shares, and we have got the cost of debt of loan notes. Now we need to take the weighted average of these figures to get the cost of capital. Now for that, we need values of equity and both types of debts. But as it mentioned, do we have to take market values or we have to take book values? They haven't mentioned anything. So in a normal situation, we should always take market values. Remember, if we can, we should always use market values. So first of all, let's take the market value of equity. Equity. For equity market value, all we have to do is to pick up the price per share and multiply it with the number of shares. Simple. So it's 3 per share, and the total number of shares will be 200 million. 200 million, because each share par value is $1. So 200 million. So I'll just write in millions. 200 into 3, the market price, and the values are in millions. Equity. So done with the equity. Let's come to the preference shares. The preference shares have a par value of $1, and there is a total value of 50, which means there are 50 million irredeemable preference shares, and each has a value of 0.9. So 50 into 0.9. Preference shares 50 into 0.9, 45 million. Okay, then comes loan notes. $250 million value, and each loan note has a par value of 100, so we have to divide it by 100 and multiply it by 100.57, the market value, to get the total market value of the loan notes. So 250 divided by 100. By dividing 100, we will get the number of loan notes like we did it in case of ordinary shares and preference shares, and then multiply it with the market price so that we can get the total market value of these. Here we go. So now we have got the total value. So the total value of market here. Okay, now I'll show you a shortcut of calculating the WACC. Just write all the KDs and KEs here. Just write them here. Okay, and then what you do, just simply multiply with these. So you just have to multiply with these and then sum them all to see how much in total you will be paying to these investors. So we will be paying approximately $95.07 million to these investors in 1 year. 13% of 600, 78 million will be paid to equity holders. 10% of 45 will be paid to preference shareholders, and 12.58 million will be paid to loan note holders. The total that the company will be paying to investors will be 95.08 against the total investment of 896.425. So what is this in terms of percentage? The company is paying 95.08 to its investors against the investment value of 896.425. So what is this in terms of percentage? And that is called your WACC, weighted average cost of capital. This is how we calculate WACC. Now I'm taking your questions. Yes, Shafi, we did not take NVT because it was only 1 year. We were standing on 30th September 2002, and the loan note was supposed to be redeemed in 1 year's time. So there was only 1 year interest payment. That's why I took discount factor. If it was supposed to be redeemed in 3 or 4 years time, then I should have used NVT factor. Shouldn't you take 10% for the second? I have taken 10%. That's okay. For calculating IRR, Asad, are you talking about the IRR? Yes, it's up to you. Take 10% or 8%. we need NPV which is negative. That's it. So I already got negative for 8%. It's up to you. Hamza, tax rate incorporate to debt. Yes, we have incorporated the tax rate here. Sir, cost of equity is derived from CAPM. Yes. In part A, we calculated this 13%. Even if the tax in A years, what we need to do is we just need to write 2 here, and we should use the second year's discount factor, but that won't make any difference because it is an ongoing project. It will be an ongoing thing for 5 years or 6 years. So areas in cost of capital calculation, usually areas are ignored, but you can take it. Redemption value. Redemption value is simply at what you are redeeming. Now, usually we redeem loan notes, debentures at their par value. So I have just written $100 as a redemption value. Any other question? So if bank loan interest is not given, can bank loan, from where did the bank loan come in? Tamur has asked a very, very good question. A very good question. Just hold your questions. I'm going to answer a very important question. Tamur has asked that, sir, what if the market value and the redemption values are same? What should we do then? Then it will be very easy to calculate the cost of debt. Now note this, everyone should note this thing. If the market value and the redemption values, they both are same, you know what? Your cost of debt will be equal to 5.6%. This will be your cost of debt. The 5.6 will be your cost of debt. Let me show you on the Excel. If redemption value and the market values are same, your cost of debt will be the same, 5.6. Let me show you. Just look at it. 5.6%. This 5.6. Remember, you don't need to calculate. The after tax interest is your cost of debt if redemption value and market values are same. Note this down. It will be a shortcut for you. No need for calculation. Tamur, did you get the answer? Yes, you can you can definitely use this shortcut because this shows your concept. This will tell the examiner that you have a very good concept. You know what? When you have same market value and redemption value, it means the only thing that you are paying to your investor is that interest. And that's what your cost of debt is. You have asked for $100 from the investor and you paid $100 back. So the only return that you are giving to the investor is in the form of interest. So that's what your cost of debt will be. Even if you do it, I did it. I did discount it. See, I have discounted it, but still I've got the answer as 5.6. Yes, it's interest minus tax, that's it. But there's a condition. If your market value and your redemption value both are same, then your cost of debt will be equal to your after tax interest rate. Okay, my last part is, without further calculations, identify and explain the factors that may change CAP's company equity beta during the year. As I told you, the equity beta shows business risk and financial risk of the company. So either of these two will change, the equity beta is going to change, right? So if business risk of company changes, it will change the equity beta. If the financial risk of the business changes, it will change the equity beta. The financial risk will change if the gearing ratio changes. So if a company gets more debts, if the company's gearing ratio changes, its equity beta will also change. If the earnings of the business are volatile, if the business increases its fixed costs, its operational gearing will change, and as a result its equity beta will also change. So there are two factors that will change the equity beta of a company: its financial risk and its business risk. So I've explained these two earlier as well. So you can simply insert financial risk and business risk into it and then link it with the equity beta. That's it. So I'm done for today. There is a question, Tufa company. That's your home assignment. I will solve it in the next class, but first you have to solve it. It is almost the same as we did now. Calculate the after-tax weighted average cost of capital on the basis of market values, which we just did. Discuss the circumstances under which it is appropriate to use current WACC. That's something I will explain in next class. And C part, this is something that you have to attempt and I'll explain in the next class. So for now, I'm done. If you people have any questions, you can ask me. Yes, I will be discussing risk management tomorrow, inshallah. Yes, yes, the same. Foreign exchange risk. Hamza, uh, due to a time constraint, I may not be able to explain the Islamic finance. But I will definitely share my notes with you for Islamic finance. For bank loan, the cost of it is always after tax interest rate. That's it. And it should be given in the question. It's difficult to assume because if you don't have the bank loan interest rate, how will you assume it? how can you assume it? What should be that value? So it's difficult to assume. So usually the examiner has to give you the bank loan interest rate. Parvati's project specific discount rate is a discount rate in which you adjust the risk of that project in your cost of equity, like CAPM does. So CAPM, since it takes the equity beta and adjusts the risk according to the investment, that's why the cost of equity predicted by the CAPM model is called project specific cost of capital. Well, what features of Excel will be available in the exam? That is something that I'll be showing you in the last day when I'll be solving the mock exam. Zainab says that, do you have any recommendations on how to memorize and retain all the knowledge areas of FM? I'm strictly against memorizing anything. Just understand things. When we go and watch a movie, we don't memorize. We don't try to memorize anything. We just try to understand the movie. And when we come out of the movie and we have to tell somebody the story of the movie, we just tell them the story, even though we haven't tried to memorize things. So my suggestion to students is always to understand things rather than just rotting things. Even if your parent company has given you a loan, you should be taking your market rate, because that parent company has its investors. So basically the investment has come from the market. Therefore, you should always use the market interest rates. So I'm ending the session for today. Yes, even if it's in another country, because ultimately you have to satisfy your investors who have given you the investment. You have to satisfy your investors. So you have to look at it from the investor's point of view. Whoever has given you the money, what do they expect from you? You should use that. Okay, take care, everyone. Talk to you tomorrow. Bye.